Do you want to know how to destroy an economy? Ask a few experts, read a bunch of books, memorize a ton of data, pull a few strings, follow a few steps. You won't even need any experience. If you can use a computer, you can crash the market. In 2001, when Jerome Kerviel walked into the regional office of Societe Generale in 1994, he wanted to work in the back office. No one pays attention to the back office. They have no clients, no one pays attention to their job, no one cares. But Kerviel liked being unnoticed. He preferred working alone in an office with computers, far from the noise of the trading floor. So he became a junior trader specializing in equity derivatives. In simple words, he traded stocks. In the beginning, he did what he was told. His boss would come to him with a client, say the client wants this, make sure we don't lose money and close the deal. But soon Kerviel was left alone in the office. When the internet bubble burst, stock prices dropped sharply. Trading volume decreased, fewer people traded and fewer people lost money. And Kerviel got bored, but he was still young, ambitious, and eager to prove himself. So he started doing more than he was told. He offered suggestions to his bosses, small ideas to improve trades or mitigate risks, but no one cared. First, no one noticed. Kerviel was still making money for the bank and staying within limits. Everyone was happy, but he was not. He was frustrated that nobody appreciated him. He knew he could do more and earn more, and that's when he made his first unauthorized trade. It was a small one, only $2 million. He took a chance, bought some options and made a quick profit. Then he did it again and again and again. Each time the stakes were higher, the risks were greater, and each time he hid his losses by offsetting them against his profits. And since he kept winning, his bosses were happy. None of them ever noticed that Kerviel was taking increasing risks. In fact, they praised him. They sent him to more training courses. They gave him more responsibilities, and Kerviel became indispensable to the bank. But he still wasn't satisfied. He wasn't taking enough risk. And that's when his luck ran out. On January 23, 2008, just days before his massive loss, Kerviel wrote an email to his boss outlining his strategy for the coming year. Subject line, my wish list for 2008. He proposed aggressive trades with high returns and low risk. His boss replied with 3 words, too much risk. But Kerry was undeterred. He kept pushing, kept taking bigger chances and winning. But on January 29, 2008, one of his trades failed. He lost €1 billion. Overnight, SsangYong tried to limit its exposure. They asked Kerviel to reduce his open positions, but he refused. He wanted to wait for the market to recover. The next day the market dropped even further. Kerviel's losses grew to €2 billion. By February, the situation was critical. The bank's CEO called Kerviel in and ordered him to close his positions, but he was too late. After 4 days of losses, Kerviel's total loss reached €4.9 billion. In one moment, he became the most hated man in finance. The news of the scandal spread like wildfire. Kerry Welland was arrested and charged with breach of trust, fraud and forgery. He was found guilty on all counts and sentenced to 3 years in prison. SocGen shares collapsed. Its market value plummeted from €90 billion to €44 billion, and it became the biggest casualty of the financial crisis. Thousands of employees lost their jobs and millions of euros disappeared forever. Kerviel's fall from grace was spectacular. Once hailed as the best trader in the world, he became the most hated man in finance. He lost his job, his reputation and his freedom. But the real damage was done to the financial system. Because while Kerviel's actions were criminal, the enabling factors were systemic. For starters, he operated in a culture that encouraged risk-taking and rewarded big wins. Second, he worked in a system that allowed him to hide his losses. And third, he benefited from a compensation structure that incentivized him to take bigger and bigger risks. In other words, Kerry Welland wasn't just a rogue trader. He was a symptom of a deeper malaise in the financial system, and his downfall exposed the fragility of a system that placed too much trust in one man's judgment. The whole market trembled because of one man's trades. But that's all for today. We'll be back soon.